Hi there. How's everybody doing? This is Sir Josias with the Real Estate Hedgehog podcast, our weekly podcast. So glad that you guys can join us. I'm here again, as I usually am every week, unless he's going across the country with my partner, Sam Yin. Sam, how are you doing, buddy?
I'm doing good. Thanks for asking. Not going anywhere right now. Kids are back in school, so I'm kind of hunkered down. What have you been up to lately?
Well, same sort of thing. I mean, right now the market is so crazy. But before I go into that, don't have any plans right now. In October, my wife and I will be going out to, where are we going to go to? We're going to go to Colorado and then over to San Antonio, Texas for a few days, but that won't be until October, mid-October or so. So for right now, kind of like you, just, taking it easy, looking at what Jerome Powell and the Federal Reserve Bank are going to do probably the next week or two.
Oh yeah, that's coming up, right? The 21st is going to announce it.
Yeah, and I mean, I think you and I are both in agreement that the chances are real high that he's going to increase it by at least 75 basis points. And again, that's putting everything in a little bit of a turmoil, because people are, I'm a little hesitant to move too quickly on anything, because I know that whatever calculations I'm making right now, 1, 2, 3, 4 weeks down the road, they won't be the same calculations just because of wherever the interest rates are going to be. So,
but well, you remember the last time I think we talked, I think it was on a podcast where I hesitated, I made the deal, and I called the bank at like noon as I'm driving away from the deal after I was satisfied. And Jerome Powell had just came out that morning at 9 to announce, and then it changed everything. The bank reacted immediately and bumped everything up.
Yeah. So you just have to be very careful, and you have to have some good underwriting, and maybe in your offers, be very conservative in your offers. And if people aren't willing to take the offer, just move on, because you don't want to get stuck in a situation where all of a sudden you were making money on a deal, and then just because the interest rates went up a point or whatever, now you're not making money and you're stuck in a deal that you don't want to be in. So. But because of that, today I think we're going to talk about a very important topic. We're going to talk about the net operating income, the NOI, one of the most mysterious and yet important numbers, concepts in real estate investing. So a lot of things are involved when you're talking about NOI, everything from the rents to whether you're going to get the loan from the bank, to whether how will it, you can use the NOI to determine whether it'll be profitable. The deal will be profitable in 5, 6, 7 years when you want to not lose it, when you want to sell the property. So it's a very important number. Sam, why don't you touch on what the basics, how do you, just real basic, and then we'll get into some of the more detailed things. How do I get to my net operating income number?
Okay, so the nitty gritty of the net operating income, or the NOI, is essentially your gross income, which is everything you're bringing in from your rents, subtracting your operating costs, which is not included with any leveraged money or debt. Your operating costs are those set costs, such as your taxes that you have to pay on the property, your insurance, the utilities, the built-in maintenance and CapEx. All these things encompass your operating costs, the things that need to get this thing going on a regular basis. So when you take everything that comes in, your gross income minus your operating costs, you're left with a net number, which is the net operating income, and that's the NOI.
Excellent. So as you mentioned, with the net operating income, the NOI, it does not, that number, you still haven't factored in your debt, your
Correct.
mortgage payment, right? So correct. Again, from that number, then you plug in your mortgage. So people, I know that bankers, they want to know, they're very concerned about what that NOI number is, correct?
Oh yeah, because it makes a difference, because that basically means that all the expenses to operate this business, if you will, has now been deducted from the gross income. The leftover money, the NOI, has to support what loan they're going to give you. So it has to serve that debt. And there is a ratio that they work with. They want to see it serve the entire debt with an extra 20 to 25% cushion. And that's where you get that debt service coverage ratio.
Right, and we talked about that, I think it was last week that we talked about, or last week or two, about the debt service coverage ratio. But what we didn't talk about then was, and I know we mentioned the NOI and everything, but today I want us to really concentrate on what that NOI is, how it works, what you can do to increase it. So yeah, so you have your expenses, your operating costs, which are your expenses, and you outline just a couple of them. You know, like you said, it could be everything from obviously your taxes, insurance. It could be your lawn care or whatever, you know, whatever sort of gardening might have to be taken care of. If you have a swimming pool, it's going to include the swimming pool. If you have utilities, you might have to pay utilities. Maybe the setup is such that your tenants do not pay utilities, and you as the owner of the property are the one paying those utilities, so you have to include that. You would include legal fees in there, your accounting fees, any administrative fees. What else could be included in there?
Maintenance, property management.
Oh, excellent. Yeah, your property manager. If you're paying
all that stuff,
a property manager, and you're paying him 7, 8, 9, 10%, that's part of your operating costs.
Your vacancy factors is all part of that.
Yes, you factor that in there. In fact, I would just say that you actually, for me, the way I calculate, and we might do our little underwriting just a little bit different, but pretty close. For me, the vacancy rate is even above your expenses.
Yeah, sometimes I do that too.
Yeah, I'll take my total rent. So like you said, it could be rent money, it could be money from other things that come into that property, and then I factor in my vacancy rate, rate, and it's usually around 5%. Although when I'm doing a more deeper calculation, I'll go anywhere from 5 to 20% to really try to, you know, capture as much of that risk as possible. And then I start subtracting my after I've subtracted that, then I start subtracting the expenses. So we do that. We're left with our net operating income. Then we subtract out our mortgage, our debt.
Then that'll leave you with the cash flow.
And that leaves you hopefully with a positive cash flow, right? And so you mentioned a number. What is that number that the banks usually want to look at on that ratio between your NOI and your mortgage?
So normally they want to see a 1.2 minimum as a ratio, meaning when you have the 1-to-1 coverage, that means all that NOI will cover the entire debt.
They equal each other.
Yeah, equal. Yeah. So 1.2 meaning there's a 20% additional amount of money as buffer. So 1.2 has been kind of the industry standard, but they do fluctuate from bank to bank. That seems to be the standard. However, now as more risk is out there because interest rates are fluctuating, some banks are requiring 1.25.
Okay, excellent. So if I'm looking to, and what I want to do is I want to maximize my NOI. What are some of the things that you can do and that you've done to increase the size of your NOI?
So the first thing, the very first thing, like I always preach, is you have to make money on that buy. Meaning out of the gate, at the onset, the price in which you purchase this property for has to be the right price, because that will dictate your NOI. I mean, literally, that is the most important factor of the NOI, because what happens is the price lets you know how much debt you need to carry, right? The NOI is not going to really change, but the price will cause the debt to decrease, meaning increasing that debt service coverage ratio, putting more money in your pocket. So that's number one.
Okay.
Number two would be to shop around, do your research, figure a way to drop your operating costs.
Okay.
And you can't control the taxes are set. You can control some of the utilities, as in to make it more efficient. You can control the insurance by shopping around for insurance. You can negotiate your property manager's fees. So those you have some degree of control over.
Absolutely. And so any efficiency that you can find on the cost side, if you can drop those costs, the more you can drop them, the higher your NOI increases. What else can we do to increase that NOI?
So the basic thing is you have to know the market. figure out what the going trend is, what the rates are for rent. So
Yes.
by looking at what it is based on what you're buying this for and what gross or what NOI is producing, you'll know if there is an opportunity, or upside is what they call it, to increase the rent, which will increase your NOI. So increase the gross income with a set operating cost. Whatever increase you're doing really is all added to the NOI.
Excellent. So I know that one thing that you and I both do, and it's kind of funny because we started doing it independently of each other, but we talked about it and we figured out we were doing it, is that we determine, obviously we should know what the going rents are. You get that from the rent roll from the seller, but then you have to figure out what the market rents are. And usually, hopefully your market rents are higher than what the rent roll is, because that gap there is that it's your ability to increase those rents. So I know that when I do my calculations, I always figure out how much more can I increase, or what's the percentage difference between my market rents and my current rents. And it might be 8%, 20%, 30%, depending. But when you have that, now wow, I can at least raise them up over a period of time, maybe not immediately, but over a period of time up to there. And as you do that, that you are increasing your NOI, especially if you're able to, at the very minimum, maintain your costs and hopefully even drop them somewhat. So, yeah. And I know that you've done tremendous work in reducing your expenses just through the insurance and negotiate insurance, pitting one insurance company against another.
That always works. You might not get the price you wish you had originally underwritten, but at least you can get discounts by shopping around for those things.
Absolutely. Absolutely. Okay, so now we've talked about the NOI. We talked about some of the expenses that you have to deduct, and every property will be a little different because every property might have different types of things that you have to consider. You should also factor in your capital expenses in there somewhere so that you're putting money aside for that capital expense, whether it's a new roof or new plumbing or some other issue that will be coming up. You got to put that money aside. So that should be included as part of your calculation when you're doing this. Now, what if I'm going through, and I talked about this the other day on one of our newsletters, that you have to look at a lot of properties. It's hard to get around that, especially in today's market. You have to go through a lot of properties. You and I underwrite tons of properties, but if I want to just get a quick and dirty number, just to get a quick calculation to tell me if I should look any further into this, what is a number that you and I both use to determine our expenses?
So, from my experience, and I think we both agree, at the end of the day, oftentimes the expenses at the end of the day always comes out to roughly 40% of your gross income. So almost half of everything that you're bringing in is going to go to expenses. And that's almost across the board. And in a way, it's kind of an industry standard as well.
Right. And I would say that for people that are involved in the commercial property space, meaning 5 units or more, the higher those units are. So if let's say that you're in the 10 to 20 unit realm, yeah, I think 40% is a pretty good number. If you're a little bit higher than that, maybe 30 units, 45. But as you get to the higher numbers, you might have to even calculate a 50% expense ratio. But again, you use that. Ultimately, you want to get what they call a trailing 12, which is a statement with all the expenses for the past 12 months, and then you'll know the exact numbers. But if you're going through a lot of properties and you need to underwrite them really quickly, that 40% is a great number. So let's say you're bringing in, just to have a nice easy number, $10,000 in rents. Well, okay, 40% is going to be $4,000. That leaves my NOI at $6,000, and then I can do the calculation for my mortgages and see what's left over.
I actually use that mindset, if you will, what you just talked about, as my cheat. So what I do is I take the gross income and all I do is I multiply it by 60%.
Yeah.
And that's when I know what my NOI is.
That's even faster.
Yeah, I don't even do this. you know, what is 40%? Subtract that from the original. I just multiply by 60%, and I know that's the number I got to work with to make my numbers right. And I account for the cap rate, and I know what I should probably offer this this seller on this deal.
Excellent. That, you know what? I hadn't even thought about doing that, but I'm going to do that from now on.
Yeah,
So
it's a quicker way, an easier way to do it, and it just makes it cuts one step out, and anything you can do to do it, you know, it helps out.
anything to become more efficient. Yes.
I think maybe if I were to illustrate something for the audience, they might have a better understanding of what it means to, or what the power or potential of that NOI allows you as the buyer or the investor to make the right offer based on what your personal criteria is for your returns.
Let's do that. I think that's a great idea.
So bear with me here. I'm going to have a whiteboard, but I don't have anything too advanced. So I'm going to be holding up a whiteboard, and tell me if you can see this or not.
A real whiteboard. Then.
Yeah, a real whiteboard. I have a little tiny one. So can you see this here?
Oh, excellent. Yeah, I can see it. I'm sure
I
our
hope the audience can see
it.
it, but let's take an example. So let's, for the sake of this case study, you're looking at a fourplex, because everybody wants to maximize their leverage and maximize what they can buy, right?
Okay,
So if
excellent.
you've got a fourplex, and let's just say that the seller is telling you that the fourplex is being rented at $1,000 per unit. So you're getting $1,000 per unit for this fourplex. You multiply that by 4, you're making $4,000 per month, correct?
Correct.
But in this game, we always count, or we always look at things in a 12-month period. So we take that and we times 12 months. So what do we get?
48,000.
$48,000. $48,000 per year is what we just talked about, your gross income. That's everything you get for the year.
Got it.
So what I would do, bear with me here. I take that 48,000, and like I said, I just cheat. I multiply it by 0.6, right? Which is basically 60%. That's going to be my NOI.
Right.
And that comes out to what?
You want me to calculate it, or you got
I think it comes out to 28,800.
it? 800. Excellent.
So that is your NOI. Okay.
Exactly.
Finally, here's the magic of the NOI. So you can look at the area, and you can kind of get an idea of what the cap rate is, right? The desirability of the area. So let's just say, for the sake of argument, that the cap rate of this area is a 6 cap.
Okay.
It's pretty good, right? That's what we usually shoot for, 6 cap or higher.
Yeah.
So a 6 cap, how you calculate the value, because that's how the lenders look at it, is you just take that NOI and you divide it by that 6 cap, or 6%, 0.06. So what do you get? You get a value of $480,000. So now you know that that is what this property is worth to you at $1,000 a month per unit in rent.
That is so cool. Let me tell you, let me just say this. That is like such a great calculation, because if someone is trying to sell you that property for, let's say, $550,000.
Exactly.
You
now
already
you know what the price is to offer.
Right.
Yeah.
Excellent. That's such a great calculation. So I hope that, I wish you hadn't erased it right away, but that's okay.
So here's what we'll do. So we know that for a 6 cap, it's worth $480,000. That's what we know.
Right.
That's what the value is, right? Because of our NOI. But what if we wanted more of a return, right? So what is the cap rate? The cap rate basically means if you paid the whole thing off with cash, That's your return rate. That's a 6% return on your money if you paid the whole thing.
Right.
Obviously, we're going to leverage it. So if let's say you wanted an 8% return or an 8 cap, all you do is you took your NOI, which is your 28,800, you divide it by 0.08. What do you get?
I'll tell you right now, 28,800 divided by 8%, you get 360,000.
360,000. So you know that if you wanted an 8% return from this property or an 8 cap, if you were to pay cash, you're going to offer 360,000. I'll take it a step further. If you wanted 10%, so now you make that 10%. What is the final number?
Divided
Pretty
by
simple. It's going to be 288,000.
Exactly.
Right? So if you wanted 10% return, if you were to pay cash on this property with $1,000 a month rent for each unit, your offer has to be 288,000. That's it. It's that simple.
Right.
Now that you know that, you can go back and look at the cap rates and look at the current lending rates. The difference is what you would make depending on what you're going to get on the loan. I won't get too far into it, but I just want to give you a quick taste of how to calculate what is the number that you should be offering. Because if you know the area generally has a certain cap rate, and that's usually, you can find that out on the internet for a certain community, then all you do is divide that by that NOI that they've given you and you verified, and now you know what you have to offer. And you just explain to the person. But here's the other side. Remember this, that it's more of an art in the sense that if you make some phone calls, call a bunch of property managers and other apartments, say, hey, bud, how much are you charging for this unit? Oh, we're charging $1,200 or $1,400. And you call 5 places and say, you got any availability? Say, oh, no, we got a waiting list. So you know that full occupancy is at $1,400. You've got a $400 per unit upside. So at that point, you might be willing to pay full price or a little more, because you know that once you get into it, this place is under marketed, if you will. Right. They haven't managed it well enough to get the maximum potential. So all these things kind of play into your thought process and your underwriting to give the right price, because the final part of my, I guess you can say, potion or formula is I get on, Zillow, or I make a phone call to a friend that works at a title company and say, hey, the guy who owns it right now, what did he buy it for? What's his tax history? Oh, he bought it for, $200,000. So this guy's going to make money.
Right.
And I want him to make money because I want him to sell it to me. I just want him to make a fair amount of money that allows me to have a fair amount of profit as well. I'm not trying to cheat the guy out of his money, but it tells me how far I can push the negotiations. Because if I find out that this guy bought this 20 years ago at $50,000 for all 4 units, and now he's trying to sell it to me for $500,000, then maybe I should, push it a little further because he's still going to make money.
Right.
You kind of get where I'm going with it? That's my quick and easy, dirty formula when I look at a product. Boom, done.
Yeah. And let me tell you, what I like about the way you're thinking there is that you want the seller to make money.
Oh, yeah.
Yes, there's negotiation, and maybe there's a little bit of competition going there, but you said something so critical. You want the seller to make money, because otherwise, why would he sell the property if he's going to lose out, right? No, he's not. And then by the same token, when we sell a property, we want to make sure that we're setting up that property so that a buyer wants to buy it because he sees value, he sees money. And if you set it up correctly by just improving the property, maintaining your rents where they should be, they're going to want to probably pay closer to your asking price.
Oh yeah, so think about that example. If it's $1,000 a unit and you've made this negotiation, you've got your 28,800 as your NOI, you're going in at a 6 cap, you made the offer for 488,000. Let's just say you put 88,000 down. and you're borrowing 400, and let's just say at a 5%, you're paying roughly $2,000 a month for your debt, for the interest portion of your debt. So that's 24,000 a year. I'm going off the top of my head here. I could be wrong.
Sure.
Minus that from the 2880, so you're making $4,800 a year in profit.
Mhm.
But if you know that the area is fully occupied, that community, at $1,500 a unit, that's $500 per unit times 4. That's $2,000 per month times 12. That's an extra $24,000 of profit.
So you have, at that point, you've pushed your NOI
Correct.
by that amount.
Yeah.
And
that's my quick math I do on everything. And that's why some people say, why do you lowball? Oh, I'm not lowballing. I have to know what works for the bank and what works for me. And everybody's criteria is different.
Excellent. Very good. You know what? That's a great conversation we just had. I'm very happy that we went through that. I loved your little whiteboard. We might have to use it again in the future.
Yeah. Next time I'll get an easel so it's easier. I don't have to hold it, you know.
I know. No, but that's great. That's great. Okay, excellent. Any parting words you want to say before we sign
No,
off?
as always, to everybody, you know, I hope they enjoy the content that we provide. It's free. Nobody sponsors us. So please do us a favor. If you like us and you'd like to hear more stuff that, you know, that we come up with, just hit that like button, subscribe to our channel. You get notified every time something new comes up. And please share it with your friends. I really wish that this could, you know, everybody could see the power of real estate investing. And we do a newsletter every Monday that comes out. Sergio takes a lot of time to do research and write, and we both provide our weekly articles to showcase our journey so you can follow along with us. And if you want to get that newsletter, just give us a quick email. You can write in the comments, ask for it, or send us a direct email to realestatehedgehog@gmail.com.
And also, today is Monday the 12th. This won't come out for another few days. You know what? People aren't gonna have enough time. You know, that's okay. Not a problem. Just, you know what? Again, we're here every week. We try to get these podcasts out on Thursdays. So we look forward to seeing everybody again next week. We'll have another topic. I hope that it'll be of interest, and I think we'll provide it in a very interesting way.
Sam? Oh yeah, hit us up, get on our email list, because you know what? We also we try to do a monthly Zoom meeting live, so we can exchange your ideas. So send us an email.
Send us an email. We'll get you on that mailing list. We'll get you on our monthly meeting list, and we'll send you a Zoom invite, and come on in, and you'll be able to participate, ask questions, give us your point of view, give us your experience. Everybody learns by doing that. Okay, Sam, thank you so much, buddy. Take care.
All right, you have a good one. See you next time.
Okay, bye.